Electric car sales in Germany have recently experienced a significant decline of 55%, marking a notable shift in the largest EV market in Europe and the leading car-selling country on the continent. The sudden drop in sales has raised questions and concerns about the underlying reasons behind this downturn. Germany's decision to abruptly terminate all EV subsidies has played a pivotal role in this development. Previously, buyers of electric vehicles used to receive substantial subsidies, which gradually decreased from around €7,000 to €4,000 before being completely eliminated. Speculation abounds regarding the motives behind Germany's decision. Some suggest it may be a strategic move to protect its car market from competition, particularly from Chinese EV manufacturers or from the growing presence of Tesla offering more affordable EV options. Others argue it might be a measure to safeguard domestic automakers or address concerns about the broader economic impact of incentivizing EVs. The repercussions of this decision are evident in the sharp decline in EV sales observed in January. This downturn contradicts Germany's ambitious plans to transition to 90% renewable energy by 2030. While the nation has made significant strides in renewable energy, the abrupt halt of EV subsidies poses a challenge to achieving this goal. Contrary to popular belief, EV incentives are not unique. Governments worldwide have historically provided substantial support to the automotive industry, primarily benefiting internal combustion engine vehicles. Germany, for instance, has been subsidizing its car industry for over 50 years, albeit primarily in support of traditional vehicles. This disparity in incentives has led to misconceptions about the fairness of EV subsidies compared to those for conventional vehicles. While the termination of tax incentives undoubtedly impacted EV sales, other factors contribute to the decline as well. Economic weakness, high financing costs, and geopolitical tensions have fostered reluctance among both private individuals and companies to invest in new vehicles. Konstantin Gül, managing partner at EY for Western European markets, highlights these underlying issues, suggesting that 2024 may prove to be a challenging year for the automotive industry as a whole. Additionally, a price war among major players like Volkswagen, Tesla, and BMW has further intensified competition in the German EV market. Despite efforts to make EVs more accessible through price reductions, the outlook for the German economy remains uncertain, particularly in the wake of significant corporate bankruptcies. In summary, Germany's decision to end EV subsidies has not only affected the immediate sales of electric vehicles but also raised broader questions about the future of the automotive industry and the country's commitment to sustainable energy transitions. The world is currently grappling with the financial woes of companies burdened with a staggering debt load surpassing $500 billion. This crisis reverberates across various sectors of the global economy, prompting analysts to anticipate continued price reductions for electric vehicles, EVs, throughout 2024. While this may benefit consumers, smaller EV companies could face significant challenges in managing these ongoing price cuts. Germany's Automotive Association, the VDA, foresees a modest 2% growth in the global passenger car market in 2024, nearly reaching pre-pandemic levels. However, the association predicts a contrasting 1% contraction in Germany's car market, with sales declining to 2.82 million cars, a 25% drop from pre-pandemic levels. Particularly concerning is the projected 9% decline in electric vehicle sales in Germany, despite a substantial 19% increase in production. Despite these challenges, Germany remains one of the world's largest automotive exporters, with manufacturers like Mercedes-Benz, BMW, Audi, and Volkswagen contributing significantly to the industry. Nevertheless, the outlook for the sector remains challenging, with uncertainties looming over global economic recovery. While Germany's car market holds significance in Europe, its impact on a global scale is relatively limited, accounting for only a fraction of global car sales. In contrast, China continues to drive the electric vehicle market, with sales surging by 80% in January compared to the previous year. With nearly 10 million EVs sold in China last year, the country's dominance in the EV market remains unchallenged. Despite the downturn in Germany, there is optimism for the growth of EV sales in Europe in 2024. This optimism is fueled by two key factors: cost reduction and technological advancements. As EVs become more affordable and offer greater range, they are poised to become increasingly attractive alternatives to traditional internal combustion engine vehicles. Analysts like Tony CRA predict a significant decline in EV manufacturing costs in the coming years, driven by plummeting battery costs. In conclusion, while Germany's car market faces challenges, the broader outlook for EV sales in Europe remains positive, buoyed by advancing technology and decreasing costs. As the automotive industry navigates through turbulent times, the shift towards electric vehicles continues to gather momentum, promising a more sustainable and cost-effective future for transportation. Thank you for watching.